Hello, and welcome to this week's Credent Connect series. And we're going to be a little more tied to markets and economy on this particular series this week, simply because our quarterly rebalance period just ended here last week. And during that rebalance period, we do adjust and kind of look at our positioning, our outlook, make sure that our kind of the way we think about the markets and the economy and the strategies is all in tune and kind of aligned with kind of what we're trying to do here over the long term and trying to achieve investment results. And on the economic assessment front, nothing much has changed in our view from the beginning of the year. And we're going to release our research again, our positioning and outlook that talks about the economy, stocks, bonds, so on and so forth. But as it relates to the economic backdrop, I know there are recency bias here with the Silicon Valley Bank and some of the perceived banking issues, perceived banking issues have generated a buzz, unnecessary buzz as to kind of the health of the overall economy. None of that has changed our view on economic recovery in 2023, consumer sentiment build-out in 2023, improving supply chains, moderating inflationary pressures, unlikely headwinds from fiscal policy, and overall kind of similar geopolitical risks across the globe. So nothing has changed much on there. We really encourage you to please read that overview because we do think 2023 and 2024 will remain constructive in what may be a very soft landing of a recessionary backdrop that is likely already priced in across the risk assets. But Alisha, kind of what I want to talk to you about, give us a little overview on the equity side of things, right? When we look at the stock market, when we look at our positioning on the global stock side, what are some changes we implemented and refined here in the second quarter?
First of all, we are continuing with our favor of unsystematic risk as opposed to systematic risk through ETFs. So within our equity strategies, we're focused on individual companies that can grow revenue, that have strong cash flow metrics, that are profitable and have less variability of returns.
Yeah.
So that is continuing from the first quarter. As far as our positioning across style class, we were overweight value in 2022, which worked out really well for us as the Fed was increasing interest rates. Now we're seeing the Fed possibly pause here shortly, maybe one more interest rate increase and then a pause, and that bodes well for growth. So what we've done is we've shifted from value to an equal weight with value and growth. Across market cap, we were overweight large cap, and we've shifted a little bit more into small and mid caps given their good valuations.
Yeah.
Across the globe, we've shifted more into international equities, and there's multiple reasons for that. One being valuations are better. Earnings expectations look better going forward. And then also currency exposures. If the dollar is falling, that's better for international equities. The last piece on equities would be our increase in flex. So we did increase flex a little bit, which is our risk off into short-term treasuries to take some risk off the table currently. And then we can redeploy that when we see opportunities.
No, that's great. To briefly recap that, right? Somewhat more of a cautionary approach, yet doing it more intentionally. A more individual equity based this time around in this particular rebalance, focusing more on cash flow and revenue streams, relatively lower betas, and really taking more of a balanced factor approach as opposed to being overweight one thing versus the other. Great insight on that. On your comment of flex, right? We did increase flex, which is kind of our foot off the gas pedal a little bit, to 7 to 9% of most allocations. When would we redeploy flex? Kind of what would be one scenario where we'd say, okay, it's time to put that money back to work?
If we see extreme volatility within the equity market, say we think that fundamentals aren't in jive with prices in the market, we can redeploy that cash by taking advantage of those discrepancies.
Love it. And our decision to put that money back to work has nothing to do with what we think is going to happen next. If we get a chance to buy in at a 10 or 15% discount, we will take that advantage because over that 2-3 year cycle, it's irrelevant, the exact entry point. We're just going to take that advantage of that discount, so to say. Awesome. Thank you. Then on the bond side, again, not much change there in our view of bonds heading into the second quarter. Give us an overview kind of our current positioning and kind of where we think the bond market is likely to head.
Our positioning within fixed income is highly investment grade, so 95% investment grade, a slight 5% allocation to high yield. Going into a presumed recession, we don't want to have a lot of credit risk.
Right.
So we're taking that credit risk off the table, just a small allocation there. And we also favor things like principal protected notes. So some sort of alternatives to traditional fixed income are highly desirable currently.
Yeah. And, we continue to believe that fixed income allocations across the board, right, are not likely to bode well for total return gains over the next 2 or 3 years. And this is likely to be the case even if the Fed does cut interest rates. If you recall, 2022 was one of the worst bond years on record, right? Down 12, 13, 14% in some instances. And for the bond market to become whole again, it's going to need something like 17, 18% gain. Not something that's feasible over the next year or two. Equities do stand a better chance. Alternative allocations to bonds do provide better alternatives for us, like Alisha mentioned, on a principal protected note side, equity market exposure, bond-like risk, right? All things we're putting together across the board. And I want to end today just kind of talking briefly a little bit about our factor exposures. And what you'll see in the research that's going to come out here on our positioning and outlook, it's going to be a 3-page component. And the second page, walk us a little bit, Alisha, on our main portfolio allocations and the general weighting across each individual segment, a large, a mid, small, growth, value, international, and kind of why do we have this backdrop design the way we do?
Sure. So Credent takes a multi-strategy approach. Our main allocation is really the best ideas of our investment policy committee. We're looking at factor weightings. We're making strategic and tactical allocation changes. So we can just think of this as the best ideas of the firm. We also offer 5 factor allocations. So we have allocations that are tilted towards dividend factors, value, growth, international, and domestic. And because the returns across these factors are erratic over time, we want to have exposure to them and build up our household allocations to incorporate multiple factors at once.
Yeah. So, AKA, we don't have a crystal ball, nor do we ever claim to have a crystal ball. We have been historically very good at analyzing the data in the very interim and then gauging factor exposures based on that. As a result, our backdrop of the allocations does take all those things into account without taking excessive risk into one factor or the other.